Hello and welcome to Portfolio Matters Weekly Update, Week 83. But before we get into it, Richard will read the disclaimer.
Thank you, Keith. Can I just say it's nice to be back after a little bit of a break in some very hot English weather. Everything discussed during the Portfolio Matters podcast is for informational purposes only and should not be considered as investment advice. Listeners should be aware that we will be discussing securities that we own or have a financial interest in. Please do your own research or consult a professional investment advisor before making any decisions regarding the topics mentioned on the show. A full disclaimer can be found at the end. Keith, what have we got this week?
Well, it's good to have you back, Richard. And our opening shot, yes, is of the Eiffel Tower in China, where the construction and property boom may have burst. We've got a section on that coming up. Okay, first of all, the news. So China unexpectedly cut interest rates by 10 basis points this week to stimulate its economy. I don't think a cut of 10 basis points will really do very much. The European energy crisis continues to deteriorate. And when we go through the data, you'll see that gas prices in particular continue to rise strongly this week. So Germany has urged customers to cut their gas consumption by 20% to avoid rationing. Frankly, I think they're going to struggle to avoid rationing. We had UK inflation data, which came in hot, and that has led to a bit of a sell-off in short-term bonds. We'll go through that. And Turkey unexpectedly cut rates when its inflation is currently at 80%. So this is UK inflation, and UK has the highest inflation rate in the G7. Now, the UK has historically had an inflation problem, and it looks like it's coming back. The regular comedy chart never ceases to amuse.
This one is particularly satisfying because the angle is no longer 90 degrees. It's more like 140 degrees. I like that one. That looks like a real prediction to me.
Yeah. Well, it's solve for inflation being 2% in 2 years' time. And I do like the fact the latest projection seems to have inflation heading to 0% in 3 years' time. I mean, how does that work?
Well, it's all made up, please, isn't it? I think, interestingly, Mark Carney is going to start to get rubbished fairly shortly because Bank of England's legacy is appalling. Yeah. And Andrew Bailey won't take all the blame for it. And the smooth, sophisticated Mark Carney is going to come in for some shellacking, I suspect.
Well,
possibly even on this channel.
Well, Andrew Bailey doesn't seem to want to take any blame for anything. So yes, I think Andrew Carney is in trouble. And now I think this is really interesting because Turkey has been pursuing unorthodox monetary policy for a while now, and it appears to be committed to this path of cutting interest rates against a backdrop of rapidly rising inflation, and has done it again. Now, that matters because we are just about to have a new prime minister. I was going to say elect, but we're not electing her, who doesn't believe that the economic orthodoxy of the last few years has delivered the goods for Britain, and is about to embark on an unorthodox economic policy which will involve quite a lot of spending and fiscal largesse against a backdrop of high UK inflation. And frankly, one of the reasons why I've moved all my money out of sterling into US dollars is that these experiments have been tried many times in history, and they don't tend to go well.
Interestingly, Keith, I read today that the US, the public sector borrowing requirement has gone up because of the increase in interest rates.
Yes. Yeah.
Sort of downward spiral, isn't it?
It is. And we'll show you in a while a chart of the UK's current account deficit, which is a record. So this week's economic data. Well, we had a load of Chinese data, and we've got a section on China coming up. So all of the Chinese data was disappointing. So house prices continued to fall. Industrial production came in at 3.8%, which is down on June and massively missed expectations. Retail sales also fell in July to 2.7% year on year, down from June. Chinese fixed investment also fell, which is surprising because generally the Chinese like to offset weaknesses elsewhere in the economy by increasing fixed asset investment, but that fell, falling to 5.7% annualized. Now, the big economic data of the week was from the US, where the New York Fed's Empire State Manufacturing Index massively missed expectations. So in July, it was 11.1. It was expected to ease slightly to 8. It came in at minus 31.1. So a massive fall. And what that portrays is a New York manufacturing sector, which is now beginning to contract and is deteriorating rapidly. US housing starts also fell, falling 9.6% month on month in July. So the housing sector in the US is also beginning to contract. And remember, as we've covered many times, the two sectors which lead the economy into recession are construction and manufacturing. And in both cases, they're now showing signs of deterioration. In the UK, the consumer confidence fell from already historically low levels to minus 44. We'll show you the chart in a second. But wage growth beat expectations. It came in, the June figure came in at 5.1% year on year, beating expectations of 4.8. So that indicates that inflationary pressures in the UK are persistent. UK CPI beat expectations, coming in at 10.1% against expectations of 9.9, and that was substantially up on June. Core CPI, having fallen in June, rose again to 6.2% in July. So inflationary pressures in the UK are persistent. And in the EU, the ZEW Economic Sentiment Index again deteriorated into August, though it did beat expectations. Expectations were it'd be a catastrophic minus 59. As it was only a terribly, terribly bad minus 54.9. Richard, some charts?
Yep, thanks, Keith. So, okay, with China industrial production, I just sort of this doesn't make any sense, does it? I mean, Chinese industrial production isn't doing this. I just don't believe it. That's my only comment on this chart. I read that China is starting to review its policy of severe lockdowns. What a surprise, because obviously the severe lockdowns hugely damaged industrial production. So I don't believe this, Keith. I think they're making it up.
Well, what I would say is their exports are actually growing quite well, but their imports aren't. Yeah, but I agree with you. I don't see how these are compatible with lockdowns. And yeah.
And 30% of their GDP is a Ponzi scheme in the process of collapsing. Yeah, Chinese retail sales. I mean, I think we're going to see some whether we'll see it, but I think China is going to go through a very, very difficult time economically over the next couple of years.
Great. Well, we have a section on that coming up, Richard.
You wish you hadn't asked me to do the charts now, don't you? China fixed asset investment year on year. Yeah, well, obviously it's declining, and that's a fairly significant decline, isn't it? I don't know how much fixed asset investment is related to property investment, but clearly there's an overlap there, isn't there? So the US empire manufacturing. So I think we've known for a while that it's likely the US is going to go into quite a severe recession, or we suspected, I not know, suspected for a while, and it rather looks as if that is what's happening now.
Well,
moving in.
I should say, Richard, that we have thought that, but the wider market has been very skeptical and has believed in a soft landing.
So this is the expectation of new orders looking 6 months ahead, and it's a little bit like the inflation charts, isn't it? Except it's
Yeah.
the expectation is everything's going to be hunky dory.
Yeah.
Hours work, that is a average week employee work week 6 months forward. So they're expecting fairly significant contraction in employment, and that would be employment income, obviously, as well.
Yeah, so some contradictory data. They're expecting a bounce in orders, but hours work to keep on contracting.
So this is the US Philadelphia Fed Manufacturing Index, and it too is showing a significant and rapid contraction, and suggests that all is not well in the Philadelphia economy. So US housing starts start looking as if they're beginning to decline fairly significantly. It is a leading indicator of recession, and that, combined with some of the other information we're getting, is very indicative that the US is in trouble. There we have the month-on-month figures, which are not looking great. US initial jobless claims definitely in an uptrend now. This is weekly data, and we've had an uptrend since mid-April or so. And continuing jobless claims looks like it sort of reached a trough in late May, possibly ticking up. So may mean that people are finding it hard to get a job now. The UK CPI, I mean, if I didn't live in the UK, well, I do live in the UK, and it's really, really worrying, and it is completely out of control. And it is a consequence of years of economic mismanagement and years of energy policy mismanagement. UK RPI. I mean, if you just go back to what the Bank of England was saying even a few months ago, it just shows how utterly appalling lack of understanding they have of how the economy works. UK real wages fell 3.7% year on year. That's because obviously inflation is so high. We are moving it fairly rapidly, I think, into a wage price spiral. I think that the two ways out of it are an tightening of moving into recession and rising of interest rates. Start to raise interest rates, the government runs into all sorts of funding issues, but it will put the country into recession very, very quickly. Probably cause a huge housing market recession, because of the level of house prices and the low interest rates on mortgages. And there's going to be an awful lot of economic pain ahead. I don't see any way of avoiding it.
I agree with you.
This is interesting. The UK unemployment claimant count is low and remaining low. Suggests the jobs market hasn't yet responded. And UK wage growth, including bonuses, around about 5%, inflation around about 10%. And the consumer confidence index is actually worse than it was at the nadir of COVID.
Yeah, and actually, on this chart, since records began in the late 1990s, so worse than the Great Financial Crisis.
And the EU's ADW economic sentiment indicator, not as bad as the EU sentiment, but as the UK sentiment, but pretty close to being the worst since records began here. So in summary, the Chinese housing sector continues to contract, and the Chinese economy is growing more slowly than it has in the past 4 decades. And I think it is not immune to what's going on in the world. It's basically a part of the world economy. US housing manufacturing sector is contracting. Leading indicators, as we have said for a long time now, we think the US is going into recession. It may well already be in recession, despite the vociferous denials of Biden. And we have a big inflation problem in the UK. I think it will persist. We will have wage price spiral. Not sure how we get out of it. And UK and European consumer confidence is an all-time low. We are heading for some nasty economic times. And I think Keith is absolutely right. You don't really want your money in sterling.
Yeah, great. Cheery stuff. Okay, on to one chart, which I'm afraid is also not very cheery.
Can I just say, Keith, I'm so glad I've come back.
You look nicely tanned, Richard. Well, you never really left, did you? You're just slightly offshore.
Slightly, yes. You mean the Isle of Wight, Keith?
Yeah, exactly.
It's a
Couldn't
tax
escape.
haven, you know.
So I'm afraid this is also not a very cheery chart. This is global disposable income, and it is falling at a rate not seen since the 1970s. And this is important if we think about the GDP formula. So GDP equals consumption minus savings plus investment plus government spending plus exports minus imports. And if we think about it on a global basis, so we know discretionary spending is contracting. So in order for GDP not to contract, consumers either have to dissave, businesses have to increase their investment. And right now, I can't see that happening, particularly as we seem to have had a tech bubble burst. And the main business investment of the last decade has been in technology, much of which is revealed to have been malinvestment, frankly. Or governments have to increase their spending. And frankly, I expect them to do so. But we're now in a position where interest rates are rising. And as Richard has just pointed out, the UK's interest bill has risen enormously with inflation. So governments face the difficult task of trying to balance the books when there are increased pressures, social pressures, asking them for more largesse, but also their interest rate bill has risen. And obviously, on a global basis, exports and imports will balance.
Well, what's happened really, Keith, I think, if you look at it sort of in the round, is that since probably the late 1990s, early 2000s, governments and central banks have determined not to have recessions. So in order to avoid recessions, they've pumped vast quantities of money into the economy. And all that's happened is we have saved up probably 3 recessions now, and we are going to have the biggest recession of them all. And it is unavoidable. And it is a consequence of foolish economic and monetary policies.
Well, I think a large part, actually, Richard, is just the energy shock, the war and the energy shock.
So I think the energy shock has proved to be the catalyst for it, Keith. But I
Yeah.
think all of the elements required to cause it were already in place, and the catalyst is clearly the energy shock.
Yeah.
I mean, a little aside, I know we need to get through this, but you could say energy has been much too cheap, and we have actually malinvested a great deal of energy.
Yes. No, I agree with that, actually. Well, I don't think it's investing in offshore winds a malinvestment, but I think that we have failed to invest in our main energy supply, which continues to be hydrocarbons. So, in summary, for the global GDP not to contract, we're going to have a big increase in government spending. And unless that happens, we're headed for a recession. So, in summary, lower discretionary spending equals lower demand. And that should mean a slowing world economy or a recession. We're expecting a recession. But above all, lower discretionary spending equals unhappiness. And I think we're going to have a difficult winter, particularly in the UK.
Yeah, I mean, I suspect that the governments and central banks will try and do the same that they've done before. I suspect that we will get more QE.
Yeah, no, I agree with you. But, you need
It
to get
will help.
inflation under control first.
Yeah.
So the current period is unlikely to be a positive one for risk assets. Expect economic and therefore market and financial volatility.
Just going back to Turkey and 80% inflation, any Turk who has had their money in either the US dollar or gold, their savings, will have been relatively unaffected by the debauchement of the currency.
Yes. So on to inflation watch. Well, we have now pretty much had all the inflation numbers for July. And what it shows is that in the US, inflation is showing signs of peaking, whereas in the UK and Europe, that is not the case. And I think it is no I think that is no surprise, because what is driving European and UK inflation is a huge energy shock, which will then lead through to higher inflation and workers demanding higher wages and a wage price spiral. In the US, because the US is essentially energy independent and the energy shock is much smaller, you just got to look at the prices in Europe of gas compared to in the US, then those inflationary pressures are much weaker. And this morning's data, we had PPI numbers from Germany, and that accelerated again. So in July, it fell slightly, but then this morning, it's leapt to 37.2% year on year.
It's extraordinary, Keith. It's, this has to feed through into huge levels of European inflation. And I know you made the comment about the UK having an inflation problem, but I think that there's a distinct possibility that UK is simply leading where Europe is going to follow.
That's very true, actually. Yes, because the UK energy market is much more exposed to spot prices than is Europe. And so European businesses and consumers will suffer the increase in energy prices with a lag. So US small businesses rate inflation as their number one problem, the highest since 1979. And if we go back to the UK and if you look at a breakdown of what's causing inflation, what I found really interesting about this was the fact it was so broad-based. It's not just energy. If energy prices come down, you're still getting a lot of service inflation and goods inflation elsewhere. This looks persistent. Going back to our conversation of last week, and I apologize once again for the very low audio quality as I've dialed in from the Lake District, but we talked about how the underlying cause of all of this was excessive stimulus during the pandemic. And you can see that in Europe, Euro area households have 300 billion of excess savings stored up. And so if they choose to spend that, you are going to have persistent inflation. So in summary, the UK has a broad inflation problem. The Bank of England will have to raise interest rates further to get it under control, and that will add to recessionary pressures because it will raise mortgage. Yeah, gone.
Yeah, you got me as well. It will crash the housing market.
Yes, precisely.
So, recession watch. We have new US job postings remain high, but they're falling. So, we'll see where that goes. And we're looking at sort of trying to put together the average of all the data. And there's been a lot of discussion about excess inventories in the US. This is to do with mentions of excessive inventory and weakening in earnings calls on the left-hand side. And on the right-hand side, it's with consumer discretionary industrial materials companies. And so basically, all of these potential issues that affect the health of the economy, they are being discussed more and more as issues affecting individual companies in their earnings calls. So I think we're seeing an overall sense of concern in businesses of the economic situation. And I from personal experience, I can say it's absolutely the case. So the ISM survey, the Institute of Supply Management, is a survey of US businesses by the New York Fed, US manufacturing businesses, about their confidence. And as we can see, the ISM tracks the New York Fed manufacturing survey closely with a lag of a couple of months. And if the ISM survey drops to around about minus 30, which is the suggestion from the Fed manufacturing survey here, that puts us, the US, into a recession the size of the COVID recession, and also a recession the size of the GFC recession. And the fall is also precipitous. So it is not looking healthy. The junk bond market doesn't believe that there will be a recession. I mean, what planet are they living on, frankly? I guess it's the search for income, isn't it? US freight rates are softening, which suggests that goods demand is falling away, or bottlenecks are being cleared, or that there's less demand for goods.
Well, I think it's the latter, Richard, but actually you do raise a very good point about bottlenecks easing, but I think they have eased by now, essentially.
And rising proportion of US households finding it difficult to pay bills. It's gone up. Actually, if you look at where it was a year ago, it's gone up by 50%, which is a very nasty size increase. So whilst there's a lot of excess savings around, it's partially distributed.
Yes, that's right. Essentially, the lowest 20% have no savings left.
So, I mean, I think investors in junk bonds are going to get a welcome to Jesus moment at some point, and they're going to wish they hadn't chased yield.
Okay, on to the European energy crisis. And this is a really frightening chart. So the grey line is French base electricity spot prices. So their prices right now. And you see that they have shot up to, I think, 500, which is a record. 500 euros per megawatt hour, up from averages of between 20 and 50 over the last few years. So you're talking about at least a tenfold increase on historic norms. But if you look at the December 22 peak future, so this is the future for peak power, it's up a further fourfold at over 2,200 euros a megawatt hour.
So that is somewhere between a 40 and an 80-fold increase. No economy can stand that. So one of the issues that France has got is they're having to close their nuclear power stations, not because of maintenance of the reactor cores, but because they can't extract cooling water from rivers.
Yeah, but that will ease over the next few months. By winter, it should ease. If it doesn't, we're in deep trouble.
Yeah.
Now, that chart compared base spot prices with peak December 22 prices. So what is the difference between the two? Well, if we look at the futures for German base versus peak, actually, there's not much of a difference between the two of them. So that the last chart does give you a good idea of how the market expects electricity prices to rise over the coming months. Now, in Europe, the bills have already started to land. Now, we featured a few last week, but to read this out, those were from private consumers in Germany. This is from Italy, which we know is going to be very badly affected by the energy crisis because it only produces around 25% of its own energy. So it says, while politicians are fighting over a hot seat, entrepreneurs are left alone in the midst of the energy jungle. For 15 days in July, I have to pay a gas bill of 978,000 euros compared to about 120,000 last year. And that is despite last year doing 20 days of work compared to 15 days in July. Now, I think this energy crisis will morph into a financial crisis. A lot of companies just won't be able to pay the huge increases in energy bills they are about to receive.
I don't think that politicians have got their heads around this at all. I really don't. Or if they have, they've proceeded to bury their heads in the sand. I mean, we are facing an existential crisis in Western economies.
Yeah, no, for a few months in this winter, things are going to get really bad. And I don't think anyone, particularly markets, have really appreciated that yet. And if we look at the UK, well, UK small, medium enterprises are already suffering from serious input price inflation. And I think the coming energy bills will push a lot of them into bankruptcy. Moving on to Russian gas flows, and this is Nord Stream, and the Russians are keeping Nord Stream flows very low. The Yamal gas pipeline, they've essentially shut. And the Druzhba, or Friendship gas pipeline, is running at a fraction of its flows last year. So total gas flows to Europe are down by 75% year on year. Now, this is really good. This illustrates the problem Germany is going to have this coming winter. It's got a maximum storage capacity of 240 terawatt hours of gas. And in winter, it burns 120 terawatt hours a month. And you can work it out. Pause, take a look at the inset calculation. But essentially, in order to get through this winter, Germany is going to have to cut its gas consumption by 25%. That's a lot. And they will protect consumers, I assume. Therefore, that means businesses will have to cut by much more than that. And as a result of the rise in energy prices, industrial consumers of electricity are shutting down. So this is European production of aluminium. And essentially in Western and Central Europe, it's down actually only about 10%. I'd expect it to be much more than that.
Well, a lot of aluminium production is powered by hydroelectric power, isn't it? And maybe there is no immediate alternative use for it if it's not connected to the grid. I don't know.
Yeah, well, in winter, I expect a lot of it will shut down. But zinc smelters have shut down. And as a result, European stocks of aluminium and zinc have tumbled to essentially zero on the LME. And this will morph into a wider commodity and goods problem. So a lot of manufacturing in Europe will just have to shut down, or its prices will have to rise. So we'll have persistent inflation. We'll have cost push inflation. And fertilizer production is down. So 25% of Europe's nitrogen fertilizer capacity is currently curtailed. So global fertilizer use will fall, and that will lead to falls in food production in coming years.
And increases in food prices. Just as a little aside, Keith, this coincides with the move from E5 petrol to E10 petrol, which is E10 petrol has 10% ethanol in, as opposed to 5% ethanol. And it's bioethanol. In other words, it's manufactured from grains, mostly in order to make fossil fuels more economically friendly. And where's the grain grown, one asks oneself? Well, a lot of it by chopping down the Brazilian rainforest, actually. But let's
Yes.
not bother ourselves with that. So, we just as we're hitting this crisis, we've also got awful lot of cereal production goes into manufacturing biofuels. Same in the US.
Yeah. Thank you, Richard. Well, this chart is an overview of European energy markets. Pause, take a look. So, in conclusion, this just looks worse and worse every week. Europe is heading into a severe energy crisis, and consumers and businesses will be squeezed. And I really think this will morph into a financial crisis and, frankly, a political crisis as well. So markets seem extraordinarily complacent about this at the moment.
They do. People just don't understand that they haven't got their heads around it. That is the issue. And I think just as an aside, Keith, the question is where should one put one's assets?
Yeah, well, you know what I've done, Richard? 95% of my assets now in US dollars, frankly.
Yeah.
And I will be looking to buy gold, but as you know, gold tends to sell off if there's a market crash, and I will be, timing my move into gold. Moving on, the outlook for inflation. Well, thank you to our Discord member, Ali Baroid, for sending me an excellent article which talked about the Fed's attempts to tame inflation in the 1970s. And the point of this article was that Volcker only managed to get inflation under control because the political mood had changed. And by the end of the 1970s, there was a general political will to tame inflation, which was not there in the 1960s and 70s. And so when previous Feds attempted to tame inflation, they only succeeded in driving the economy into recession, and that killed inflation. But because governments were then committed to essentially fiscal largesse, then inflation recovered whenever the economy recovered. So if you look at the charts on the left, the top chart is the federal funds rate, and you'll see that there were various phases of raising interest rates to fight inflation. And the chart below shows the inflation rate, and high interest rates succeeded in killing the economy, which is the gray bars at the top, which did bring inflation under control. But the moment the Fed relaxed and cut rates and the economy recovered, so did inflation. And frankly, that is what I think is going to happen in the coming period. I think we're entering a period in which inflation will be persistent. And so we're going to have this cycle whereby the only way central banks get inflation under control is by driving the economy into recession. So what that means is you need to be nimble in playing the cycle. Inflation will be persistent, and expect economic and financial volatility. Richard, your thoughts?
Yeah, thanks, Keith. Very good selection, very depressing selection of slides. And my thoughts are that there are going to be unpredictable consequences from this, because if you say take aluminium and zinc stocks are zero, there's a consequence for supply chains, manufacturing stock, there's manufacturing spare parts, and this is across the board, or the manufacturing of spare parts is too expensive. So the consequences of this degree of disruption to our economy, I think, are highly unpredictable, but probably very unpleasant. And I do wonder whether we are going to hit some very, very severe social unrest, where there will be wars as a consequence of energy energy deficits. I think the US is probably sitting pretty because it's energy self-sufficient
Yeah.
in a way I think probably no other country in the world is.
Yeah. I particularly fear in the UK the populist economic policies.
Yeah. Well, they'll just make it worse, won't they? They'll make it better for a short while, and they'll make it worse in the long run. So I'm pretty depressed about the whole prospect. I think it's just that you have to be very, very wary of what's going on. It's going to be very unpleasant.
So the implications are it's going to be very difficult to maintain the real value of your investments, is the bottom line, against persistent inflation and inflationary cycles. Okay, on to China, Richard.
So China, we've talked about over the past few months. I've talked about the fact I don't really believe the Chinese economic data particularly. I think they massage it significantly. The year-on-year growth in industrial value added is still at 4%. Exports picked up to 24%. Year-on-year gain. Fixed asset investment slowed. They're 3.5%. Did it? I don't know. If there's such a property crunch, I'm not sure about fixed asset investment. Retail sales weakened to 2.7% growth, but they've had these big lockdowns, huge lockdowns in what are the most the wealthiest parts of China. So I don't necessarily believe that. Property sales contracted 29%. I do believe that, and construction starts to decline 45% or more.
Yeah,
I would suggest. Private sector credit growth slowed to 8.6 from 8.9%. A lot of private sector credit is actually goes into purchasing property. So I'm not sure that I necessarily believe that, although it's very difficult to sort of tease it apart, isn't it? So China has cut its interest rates a little bit, but not by very much, as we mentioned earlier, by about 10 basis points. And it's done to try and presumably boost the property market to an extent. I don't think it will succeed. So Chinese house prices are very high compared to both incomes and rents. Clearly the Chinese government doesn't want the Chinese housing market to crash because a lot of people have their entire net worth in the housing market, and that would put them into severe negative equity. But gross rental yield 1.6%. Price to rent ratio of 62% in the city centre. Mortgage as a percentage of income, 300%. There's an awful lot of froth there to come out of the system if it collapses, and I think it will, unless the Chinese government prints large sums of money, in which case down to some inflation instead. And we won't go through this table in detail, but that's interesting to look at. It shows you how expensive the Chinese housing market is relative to any other country, which also it tells you how far it has to fall. And a lot of property markets are very expensive, including the UK.
Yeah, but that doesn't even appear on this chart, frankly. China and Hong Kong of the developed nations are, massively higher.
The Chinese property sector is contracting. I think we know that because of all the problems we've had with the property developers' bonds that we've seen over the last probably 6 to 8 months. China floor space sold, and Chinese home prices continue to fall, but not by very much. But I think if that gains some downward traction, then frankly all bets are off on the Chinese economy, because there will be a housing market crash of epic proportions. The bank lending sector, the property market, has fallen for the first time in a decade. Well, jolly sensible of people who aren't investing in the property market, one would have to say. And if I were a Chinese bank, I would be very worried about my portfolio of property loans.
Yes. But then they're ordered to invest generally, Richard.
But even a command economy will collapse in the end, Keith, won't it? Chinese Communist Party tries to control this. If it's going to collapse, it's going to collapse. speaking of collapsing, Chinese construction activity is collapsing. It's gone from, in 2021, on the right-hand chart, the construction activity index, I think I'm right, has fallen from 30 to minus 13.
So obviously there's a bit of a post-pandemic bounce, but it's since collapsed.
And with collapsing property construction of all sorts goes a collapse in the need for steel. And that bodes poorly for steel producers.
Yes, but also, you were talking earlier about the lack of credibility of Chinese statistics. Well, now this is market-based confirmation of the other statistics.
Yes. Yeah, that's true. It's independent confirmation, isn't it? Yeah. Chinese industrial activity stalled. We discussed this, obviously, property market and the COVID lockdowns, the draconian COVID lockdowns. That's slightly contradictory to the increase in exports, which suggests that, in fact, the Chinese economy itself, if the increase in exports is correct, suggests the Chinese economy itself is contracting dramatically.
Yes.
Chinese retail sales, as we saw, stalled. Car purchases are strong. As we discussed, fixed asset investment is falling. And the Chinese government is boosting infrastructure spending, trying to offset the contracting private sector construction. And it will succeed to a point, but only to the point that it can afford to do so. And the danger is they create a lot of inflation. I mean, the real fundamental issue all of these economies have is they have brought forward so much economic activity by vast levels of debt. And it's like a piece of elastic. You stretch it so far, and at some point it springs back. And when it springs back, you bring forward 100% of GDP and it corrects by 50%. Your GDP in the year it corrects is 50% of what it would have been. This is, okay, it may not be as dramatic as that, but that is, if you overextend debt by 50%, that has to come back to affect your current GDP over the next couple of years, and it can produce huge reductions in GDP. People just don't understand this.
Yeah, that's a very good way of putting it, Richard.
Yeah, I mean, they have to have, the property sector of China is 30%. If they're going to, and it's plummeting off a cliff, they can't then replace it with 30% of the GDP in infrastructure expenditure. So the whole thing is slowly collapsing, I think. Now, what the geopolitical consequences of that are, I don't know. Does the Chinese Communist Party implode, or do they start a war with Taiwan?
Yeah, that's the concern, frankly, to divert people's attention.
And this is that shows heavy equipment sales, youth unemployment in China is at 20%. That causes huge social unrest. I mean, it was 20% in Spain, wasn't it, after the GFC, and that was very dangerous to Spain. Chinese consumer confidence is very poor and falling fast, and Chinese exports have boomed, which is good for the economy. And the one optimistic sign, but imports tailing off, which makes you wonder whether there's there's clearly a lot of pressure internally in China too, and internal consumption is probably falling rapidly. Once exports start to fall, which I suspect they will, and it's not really a credit impulse, is it? It's tiny. I think there will have to be a global currency reset. I mean, I suspect that will be the consequence of all of this in some way. Whether.
Yeah.
I mean, if you sort of think of it, if you just look, say energy prices in euros go up 30-fold, please.
Yeah.
Well, then the euro is worth. Let's say they go up. The euro is worth a fraction of what it's purported to be worth in reality, and it needs to be replaced. And so you can't continue to use a euro if it deflates that quickly, that fast.
Well, honestly, Richard, I think you can. And also remember, those prices are only going to last for probably 3 months. then they'll come back down rapidly. And then over the course of the next few years, Europe will invest in LNG import terminals. And the market is forecasting that in 3 years' time, prices will be back to normal. Now, there are reasons to doubt that, because if you look at the marginal producer, which is the US, well, a lot of its big fields are approaching maturity. Will it actually be able to provide the gas to the rest of the world? It is the only marginal producer currently. And we'd need to invest a lot in new gas fields, which is absolutely possible, but frankly, is not happening right now.
Yeah, I mean, my concern really, Keith, is that this causes such a huge shock to industrial production that the economies just don't recover from it, or it takes decades to recover.
I'm more optimistic, Richard. I think human beings
probably just as well you are, Keith.
Well, I think the game I play is like trying to time the bottom. I mean, like at the bottom of the great financial crisis, I got the timing wrong, but my instincts were right. We do recover. And the same with the pandemic. Again, I was too early, but my instincts were right. We do, human ingenuity is an amazing thing.
Yes. Yeah, no, you're right, Keith. I mean, I'm feeling particularly gloomy about it because it's all the news everywhere is so bad. Yeah, so this is the indication of the stress levels of Chinese property developers, where the yield on their bigger bonds is now about 150%. In other words, they're worthless. They're going bust.
Yeah, but I find this a really interesting chart though, because we've talked about this throughout the life of this podcast, and again, it's a great indication of you should cut your losses early. I mean, why didn't this go essentially from whatever it is, 8% immediately to 80%? It should have done.
Yeah, but it crept up.
Yeah.
So China faces this demographic squeeze, and one of the reasons that its economy is likely to struggle for the next many decades is its demographics. You could see that the number of whatever happens, unless they have very high fertility, in which case the demographics decline and then stabilize in around about 2050. If that doesn't happen, then the Chinese economy basically slowly degrades to not very much, especially if fertility rates remain low.
Yeah, they're currently extraordinarily low, actually.
Yeah.
And the Chinese economy looks like China will get old before it gets rich.
It does. It may even be at its peak.
Yeah.
Or have actually passed its peak now. So our summary is the Chinese economy is struggling. The housing bubble appears to be bursting. Well, yep. And it is likely to lead to a prolonged economic slump. So actually, Japan, 1990 to now is 30 years. You add 30 years onto China, and it's in the midst of a demographic crisis. So the outlook for China over the next 50 to 100 years, which is a long time, I grant you, is very poor. So what are the implications of Chinese import demand will slump? This is a longish term. This isn't going to happen tomorrow. Bad for commodity prices, bad for exports to China, and good for developed world inflation in the long term.
Okay, thank you, Richard. And because this is the last weekly for 2 weeks as I go on holiday to the Far East, we've got extended sections, and this is another section on US housing. And reminder, we do a lot on US housing because it is a leading indicator. Now, this is buyer traffic, and buyers are losing interest quite rapidly in the US housing market. This is the number of active listings, and it shows that inventories, though low, are rising rapidly. So house prices have risen 8.2% year on year, but that is in decline now. So house prices appear to have peaked. And the median asking price is still up 11.9% year on year, but beginning to fall. But vendors are now cutting prices. So houses are not being sold, inventories are rising, and to get a sale, people are having to cut their prices. And that's the most number of price drops since at least 2015. And the reason the housing cycle is turning is that mortgage costs have risen a lot over the last year, up 37% year on year, and that has to curtail prices. So pending sales are down 16% year on year. And if you look at the seasonality of this chart, then housing sales tend to decline further going into the winter months. But 43% of US homes still sold above list price in August.
Right.
Although not by much. The average house price was 100.6% of list price, although that is rapidly declining. If current trends continue, you're going to be selling at a discount very soon. The home buyer demand index is down 9% year on year. I'm surprised it's only down 9%, I have to say. Existing home sales are falling rapidly, although the absolute number remains pretty respectable. And new home sales are also falling rapidly.
It's the speed of the decline that's concerning, isn't it?
Yeah. But the house builders have started a lot of houses prompted by the big rises in house prices. And that supply is coming on stream. So hence the build in inventories. So new homes for sale were 473,000, an annualized rate in June. Now moving on to mortgages, well, see that actually the down payment you have to put down to secure a mortgage is at a historically low level compared to the period pre-GFC, but has picked up on recent years. But debt to income ratios are stretched and close to their highs of pre-GFC. Historically, there's been a very strong relationship between the unemployment rate and the default rate. But you notice that during the pandemic, a gap opened up between the two as banks were relatively forgiving of missed payments. And those foreclosures have really yet to come through, and they're coming through in waves now. So we expect to see a wave of foreclosures in addition because of the coming economic crisis. This chart just illustrates that point. There's a backlog of foreclosures from the pandemic that are yet to work their way through. And US homeowners can tell which way the wind is blowing and want to try and sell their homes fast before the current high prices completely collapse. So Google searches for sell my home fast have spiked. Reminder, home affordability has collapsed and is now worse than it was at the peak of the great financial crisis and the house price crash that followed. But talking about the prospect of a financial crisis, lenders this time have been more prudent. So you'll see they have been lending mainly to people with good credit scores. Compare that to pre-GFC, when actually a lot of the mortgages were to people with much lower credit scores. So hopefully lenders are in a much better position to withstand a slowdown, and we should not see a repeat of the financial crisis. And as house prices fall, so there will be a wealth effect, particularly for the bottom 50%. demand has been supported over recent years by people withdrawing equity from their houses. That's going to stop. So in summary, the US housing market is slowing down. And we know that the housing cycle is the business cycle. As house prices turn down, construction activity turns down, so with a lag will the US economy. Onto other charts, Richard.
The UK trade deficit hitting a record low, a big record low as well. Nothing small about that, is there? It's not healthy at all, and not good for our currency. 25% of economists are professional idiots. I mean, well, we have a slightly jaundiced view, I would say, of economists on this podcast. We don't think they are worth what they're paid. There may be a few of them who are, but the majority of them are charlatans, in my view.
Well, the thing is, given the Bank of England itself is forecasting a recession, I mean, 25%, this implies that 25% of the economists see the UK escaping recession. I just don't see how that's possible.
I don't. The problem with economists is they work on a linear model, and the economy isn't a linear model. That's why they always get it wrong. And until they start working on non-linear models, they're going to get it wrong. But people listen to them. It's the tyranny of the expert, isn't it?
Yes, we're trying to pretend that we're sort of experts or knowledgeable in this, Richard. So,
Yeah. Just the odd rant now and then. Oh, okay. So Europe's zero interest rate policy was bad for its financial sector. This chart is showing us.
Yeah, well, that's exactly what you'd expect, because, European consumers who put their money on deposit in a European bank, well, the bank then has to put it on overnight with the ECB at minus 0.5%. I mean, it fundamentally destroys their margins, and you can see that here.
Yeah. Apart from that, Keith, it's a good policy. It's designed by economists. So, it's not. Don't be so disrespectful. The German property bubble is at a top. One suspects. Yes, I think there are probably a lot of property markets that are at its top, and at their tops even. So it doesn't look healthy, does it? When it drops back down to 100, there's going to be a lot of Germans. But the same thing's going to happen throughout Europe. I mean, you can't afford to buy a house because you can't afford to heat it.
Well, exactly. Yeah. There's so many pressures on consumers now.
So moving on to the weekly checklist. Actually, a fairly quiet week in markets, really. Pretty much the big stock markets we talk about, pretty much unchanged on the week. Hang Seng down 2%, Topics up 1%. Bitcoin, bad week. It's had some good weeks while I've been away, and it's a bad week last week. And the US, the pound is basically, is it going to parity? I wouldn't be surprised. The euro is probably going to parity. The dollar index is probably going to go up to 115 or 120, causing all sorts of economic mayhem throughout the world. So the S&P has recovered more than half of its losses that it made in the fall to June. A lot of people are suggesting that it is now going to fall back down below the June low as a classic bear market rally or suckers rally. I wouldn't be in the least bit surprised if it does, given the ISM projections that we talked about earlier. The improving contrarian, in a sense, improving breadth suggests that this rally may be sustainable. Well, it may be sustainable. I suspect it's not, but I am agnostic in terms of my financial exposure to it because I have none. So,
yeah. Well, there's been loads of chatter about this is the start of a new bull market.
God, I think my internet connection's crap.
Yeah. Oh,
the bears aren't buying the rally. So US stock bears increased bearish bets despite continuing equity gains. There's a significant population of traders think that this is just a bear market rally.
As do we.
US household equity flows versus the S&P 500 return. So the S&P 500 in gold, total return over 2 years, and US household equity flows rolling 2 years, suggests, doesn't it, that US household equity flows are going to dramatically decline.
Yeah, well, what this is showing is that US households are supporting the market. Professionals have been continue to be more bearish, but US households continue to buy. And I don't think this market will really turn until we've had a collapse in US private sector buying of the market.
Yeah, I think you're right, Keith. Earnings revisions are deeply negative. I think we have been projecting this would happen for a long time, although economists had not been, or analysts had not been projecting it. Probably are still actually not projecting it. But not surprisingly, earnings revisions are deeply negative and will probably continue to be deeply negative for some time to come. Obviously, augurs poorly for the S&P US stock markets. At some point, people will consider they've reached the bottom, though not yet, one suspects. All Star Charts thinks that this is the start of a new bull market. So it's rationalizing why we're about to have a new bull market. I don't buy it, but he may be right.
Well, this is just the sort of stuff you get all over Twitter, frankly. Everyone finding reasons why, this pattern is the start of a new bull market. But I like this. Taught me a new word. So the word pareidolia, which I like, is the tendency to perceive a specific and often meaningful image in a random or ambiguous visual pattern. And if we turn back to the last chart, I think that's all you need to know.
I can see lots of smiling faces in those, Keith.
Yes. Does this come through?
Yeah, we've talked about sterling and it's on its way down, which is going to make our inflation worse, particularly as we import so much. And Bitcoin, yeah, it doesn't look good, does it?
Okay, thank you, Richard. On to commodities and energy commodities. Well, the bad news out of China caused worries about demand. So oil had a bad week. Brent was down 2%, as was WTI. But in Europe, gas prices just keep on rising. So Dutch natural gas futures rose a further 17% on the week and now up 241% on the year. UK natural gas futures rose 16% and up 167% on the year. US natural gas prices rose 3.4%, but are still up 143% on the year. Coal also rose, up 144% on the year. Uranium was pretty flat. Now, some data specific to the oil market. Now, last couple of weeks, we've had inventory rises. Well, that completely reversed this week. So total US crude inventories fell by 12.6 million, and private inventories fell by 9 million. So releases from the SPR were not sufficient to fulfill private sector demand. And the SPR is drawing down, and that can't last forever. US crude production ticked down by 100,000 barrels to 12.1 million and is only up 300,000 barrels on the year. Baker Hughes rig count was flat. So this is crude oil off from its highs. Now, when we look at inventories, it appears that US demand for gasoline, which we've talked about had been falling, has recovered as oil prices at the pump have fallen. And so inventories have started drawing down again, and that is bullish for oil prices. And here you see gasoline demand has risen as prices at the pump have fallen over the last few weeks. Now, this is a really important chart for the long-term outlook for oil prices. And it shows the average size of discoveries in the North and Norwegian seas over decades. So In the 60s and 70s, we were finding huge fields. And over progressive decades, we've found smaller and smaller fields. It's going to be very difficult to find replacements just for the production we already have. We need to start investing right now in new oil and gas exploration. These are Dutch natural gas futures, and prices now are above their record spike at the start of the Ukraine invasion, and they're grinding steadily higher. And to show how desperate Europe is for liquid natural gas, this is a cargo of Australian LNG that is currently on its way to the Isle of Grain in the UK. So Europe is outbidding Asia for Asian LNG. And that's despite the increased costs of transporting it literally halfway around the world. If you look at the advantage the US has in low energy prices, I mean, this is it. See, so these are all priced in dollars per million British thermal units. And you can see that prices in Europe and Asia are multiples. They're 5 times higher than in the US. These are UK natural gas futures heading steadily higher. US natural gas futures are not falling higher because the export capacity is now full, and so rising demand elsewhere in the world cannot be met by exports from the US currently. Obviously, the US is investing in new LNG export terminals, but those will take a while to come on. When they do come on, US natural gas prices will tend to converge with those in the rest of the world if politicians allow an unfettered market, which I doubt. Coal prices seem to have hit a high and are now no longer rising. Now, reminder, China remains hugely dependent on fossil fuels. So just under 75% of its electricity production is from coal and gas, which is interesting when you think that China now has the world's largest EV fleet, which we all think is very green, but actually their electricity they're using is 75% fossil fuel. The skeptics have a point. This is uranium. Richard, industrial commodities.
So industrial commodities, interestingly, if you look at the year-to-date change, we're 7 months through, obviously. Aluminium, cobalt, copper, iron ore, neodymium, tin, and zinc, all down year-to-date, some substantially. And the exceptions on this table are lithium, which is up 73% year-to-date, chromium up 7%, nickel up 4%, and ferrovanadium up very slightly, 1.5%. So this is showing, I think, that there is a general trend in declining industrial commodity prices, which is probably due to the economic slowdowns that we're experiencing for the reasons we've all discussed ad nauseam above. And I suspect that this is a trend that will continue.
Well, you notice that industrial commodities are drawing down, probably because a lot of them go into the Chinese construction sector, frankly, whereas the battery metals like lithium and nickel have not done too badly. Lithium's doing incredibly well.
Yeah.
Okay, on to charts. Well, aluminium, despite the fact production is being curtailed by very high energy prices, well, the price has collapsed. Cobalt, price come off. Dr. Copper, is diagnosing that the world is feeling slightly unwell. Chromium, iron ore, having had a brief bounce the last few weeks, it's coming off again. Lithium, flat. Neodymium, declining. Nickel, well down from its extraordinary highs during the short squeeze. Tin, flat, well down from its squeeze earlier in the year. Ferrovanadium has stopped falling. Zinc, well, it's coming off despite capacity being shut down in Europe. And onto precious metals, Richard.
The last 4 weeks or so for precious metals have been relatively good. The last week has been not so good. So, and the year to date, gold, silver down. So silver is very volatile, much more volatile than gold. And so last week was not a good week for any of the precious metals. And over the year, the only precious metal that has done well is palladium, which is up 13%. Of course, this is dollar prices. And if you look at the prices in pounds sterling, then the relative performance has been substantially better.
Yes. But what I'd say is this week, of course, the UK inflation numbers led to a spike in short-term rates, and that appears to have been very bad for precious metals. So this is gold price, very disappointing, drifting off again. Silver, platinum, rhodium. I'm surprised rhodium has not fallen further, as we know that car production is being curtailed.
It's maybe a supply issue as well. Difficult to know, isn't it?
Thank you, Richard. On to the weekly rates checklist. And the UK inflation numbers led to a sell-off at the short end, and a dramatic one. So the UK 2-year rose by 39 basis points from 2.05% at the start of the week to 2.45% at the end of the week. But at the long end, the rises were much more muted. The 50-year only rose by 6 basis points, which suggests that the market still believes in the Bank of England and its commitment to get UK inflation back down to the 2% target. So the market is essentially saying it expects the Bank of England to raise short-term rates more sharply to get inflation back under control. Now, the sell-off in rates also spread to the periphery of Europe, where the Greek 10-year rose by 34 basis points on the week and the Italian by 30 basis points on the week. Go on.
Oh, sorry, just going to say, looking at the year-to-date changes, I mean, the year-to-date change in percentage terms is for Greece is nearly tripled. Sorry, nearly doubled.
No, you're right. It's nearly trebled. It's more than doubled. So it's gone from 1.28% at the start of the year to 3.6. So
that's an inflation rate of 600, 800% per annum annualized. It's extraordinary. And if you are exposed to interest rates in these countries as a business and you haven't fixed, you're just exposed to the spot rate, then your costs have gone up threefold.
That's true. That's very true. Okay, so these are German bond yields, which are also rising. Italian. Reminder that if the Italian bond yield on all maturities, so the general interest rate on all its debt, were to rise to anywhere near this level, Italy would be bankrupt. Greece. The UK 10-year rising rapidly. US, less so. And finally, onto the seasonality chart. And we're entering the end of August when markets start their decline into Q3. So, concluding comments. Well, I'm afraid the general tone of this weekly has been pretty apocalyptic. The global economic data looks increasingly poor. Now, what's interesting is inflation outside the US looks persistent. The energy shock in Europe and the UK is spreading via wages to services and is broadening, leading to persistently higher inflation. So it looks very much like Europe is going to have an incredibly tough winter. Okay, sorry.
I was going to say one small point. I just like, well, not a small point actually. We just mentioned Italian debt affordability, and of course the ECB has got this. I can't remember what they call it, but to basically step in and buy Italian bonds if need be to avoid the European crisis. It's predicated upon the strength of the German economy, and if the German economy hits a crisis, which is entirely possible, then the ECB may well not be able to hold Italian and European periphery interest rates. And that then threatens the Eurozone, the financial system in the Eurozone.
So well, I disagree with that, Richard, in that if there's if the German economy weakens, then you'd expect German rates to come down. And so it would be then easier for the ECB to sell German bonds because there'd be demand for them and buy Italian ones. Although the size with which they would need to do this, given that Italy will be trying to expand its budget deficit, could well pose a problem.
Well, it's a question of affordability, I guess, isn't it, Keith? Because there's only so much money, unless the ECB starts printing again, there's only so much money that is available to purchase European government bonds. And if market interest rates get forced up because of inflation, then it is Germany that backstops the European financial system.
Yes, essentially, you're right. What the ECB would be doing would be selling German bonds, buying Italian ones. So essentially relying on the fiscal strength of Germany to support Italy. Now, you're right. This could go really badly, but I hesitate to follow through the logic of that thought because the things get incredibly nasty. And I think we just have to wait and see. Obviously, this crisis could go very badly, but the Europe has shown incredible amounts of solidarity when it really matters. So we can only wait and see what they're going to do.
That is very true, Keith. Yeah, you're quite right.
Okay, what have you been up to this week?
Thank you, Keith. Well, I've done nothing since over the last few weeks. The only thing I've been doing is I've been slowly moving cash into gold, and I actually use the Sprott Physical Gold Trust for that because they own physical gold as opposed to GLD, which doesn't really own the physical gold. So I don't want to get caught in a gold ETF that doesn't own the gold when push comes to shove. So that's why I use the Sprott. So and my performance of the year has been pretty mediocre to say the least, and but that's the only activity I've been undertaking. So effectively, this is the pie chart that I showed a few weeks ago. It hasn't changed. Oops, sorry. The blue is the cash plus PM. So basically, I've just been shifting a little bit around in that, and I'm going to continue transferring cash into gold for the time being. It's a dollar-denominated asset. I don't have any faith in the pound, and I don't want to invest in the stock market. And that's it. So not a lot to report. How about you, Keith?
Thank you, Richard. Well, I had a decent week, actually, up 1.5%. and I'm having a very good year. Now, viewers will know that I have been buying long bonds, which hasn't really worked. But what has worked is moving assets out of sterling. And sterling has sold off again over the last couple of days due to persistent inflation. During the week, I added to my position in the iShares US Treasury 20-year plus ETF. Frankly, when you look through the data, everything looks really bad. It looks like the US is heading into recession. As the US heads into recession, then inflation there will come down, and so will bond yields. And so I have a big allocation to that. And I have a very high conviction rating. So this is my asset allocation. You'll see that the vast majority of it is now in US bonds and I have this week invested more of that cash into long-term bonds. This I showed last week and just shows my asset allocation and how I very much try and time the market. So you'll see that the blue line is my allocation to equities, and I've rapidly switched earlier this year in May from equities into cash and then have been reinvesting it in bonds. This is my bond allocation. So for years I had nothing, and then suddenly bang. Okay, so one stock I wanted to talk about this week was Goldplat, which is my remaining gold specialist. I'll say gold producer. It doesn't actually mine gold. It recovers gold from mine waste. And the reason I retain the shares is because it is much less energy intensive than gold mining. And it had its Q4 operating results out this week, and they were great. So its operating profits, which I realize are not the same as post-tax profits, but the operating profits were up 51% year on year. And a lot of the value of Goldplat is in its tailing storage facility, which it estimates contains around 80,000 ounces of gold. And if it can process them, then that unlocks a lot of value. Now, they have got permission to open a new tailings storage facility, and that means they can put new tailings into the new facility and start processing the old one, unlocking a lot of value. Now, there's still a few permits and water rights that need to be sorted out, but that could happen hopefully quite soon. Market cap is quite small. I have a decent position in it, but I have put in orders to buy more. Looking at US Treasury bonds, this is the price of the US 2051 and hasn't worked so far, but logically, I think it will. And I remain very much committed to this trade and quite relaxed about it. This is the other US 2051 Treasury bond I own. Again, not great. UK 2071 gilt, frankly, didn't suffer too much from the raised inflation print this week, but I have low conviction on this. This could go badly. If the market comes to believe that the Bank of England is not in control of inflation and UK inflation will be persistently higher, then the UK 2071 gilt could really sell off. And if Liz Truss comes in and starts to play around with the Bank of England's mandate, she is playing with fire. If the markets come to believe that there will be political interference in the Bank of England from now on, then the gilt market could sell off. And that would be very bad for UK government solvency, essentially.
Thank you very much, Keith.
So any final comments before we go on a bit of a break for a few weeks, Richard?
No, I think we've probably done enough. Well, I've done enough doom and gloom, Keith. You've done your best to intersperse it with a little bit of optimism. But I think we just need to be really, really careful and not. Now is not the time to be speculative, I think.
Yeah. So, I mean, the bottom line is I think you really need to be quite nimble just to preserve your capital currently, let alone grow it. And so I think we're heading into potentially a very difficult Q3 and Q4, and just be safe out there, essentially.
Yeah. Completely agree.
Great. Okay. Well, thank you all for watching through to the end. Please, can you press like and subscribe to the channel? And in the meantime, it is goodbye from Richard Wheater.
And it's goodbye from Keith Jordan.
Goodbye.
Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only and should not be relied upon for making a business, legal, or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website or to any information, products, services or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information. Nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.